Hey, Gowinvest family. Welcome to lesson 6 of Gowinvest 101. So it turns out yesterday when we were doing the live trading, I realized I never told you guys how to pick stocks. And today, that's all what this is about. We're going to cue the intro and see you in a bit. Hey guys, today we're going to be talking about picking stocks. So, number one step to picking stocks is building a watch list. This watch list could be any stock that you might hear on the news or hear here and there that might be big, right? It's into like cryptocurrency as well as Mara. You've got GameStop for the big play. You've got Roblox, which is a new IPO thing for the game that all the kids are playing nowadays. When you see a stock that you're interested in, say you heard about a company, you searched it up on the symbols chart, so you check out Palantir, Palantir. Well, I don't know, Palantir. So then you click on it, you make sure that you click the little star button over there to add it to your watch list. You can also set alerts on it when it goes above a certain price or below a certain price. I don't usually do that. I just add it to my watch list so I can see it here. This is the number one thing to do. Okay, make sure that you have all the ones that you want to see in your watch list. Next, what you want to make sure to have is these stocks. Make sure that they're mid caps. So market caps should be around the 1 billion mark. If they're lower than that, you might want to stay away from them because, in case of a penny stock, you might go into like within 400 million or above. My suggestion here is make sure that you check the market cap and keep it hopefully above $1 billion. So you're trading mid caps and you're not trading something way too risky. Next thing to do is make sure that the exchange that they're traded on is NYSE or NASDAQ. Because if they're anything else, say even Amex, the reporting is not the same that you would get to the quality of NASDAQ and NYSE. I mean, in this case, I think my only Amex one was Zomedica, and that was talked about by a Zip Trader. So that's why I have that. But other than that, majority stick with NASDAQ and NYSE. One of the biggest things that you could potentially play on is ETFs like SPY. You could also play on UVXY, SVXY if you're going bear or bull. So say when the market goes up, SVXY will go up. So let's say the market went up yesterday, so SVXI would go up. And on the inverse, if you wanted to play a bad day, you'd probably go on to UVXY. But in this case, because the SVXY went up, UVXY goes down. Similarly, if you were playing the gas prices, you'd probably do UCO for the bull, I think, and SCO for the bear. So these go short. So when gas prices are going up, or the trade is going worse for oil, this SCO will go up. When trade is going good for oil, then UCO will go up. So that's one thing to play. You can play UCO, SCO. You can play JNUG, G for gold, and DNUG. What was the inverse to JNUG? JDST. So JDST is the bear. DNUG or JNUG is the bull. So JDST is the bear, JNUG is the bull. You can play on these inverse pair relationships that we just looked at in order to play one side or the other of gold prices, gas prices, stock market. Make sure that you play responsibly because one of these will go up while the other one goes down, but it's a good place to play what I talked about in terms of the Bollinger Bands. It's a little more steady. Now, what else did we want to talk about? We talked about mid market cap. We also want to talk about volume. You want to make sure that this volume has a high volume. So in this case, we are going to inverse it, and we see that ASML, Dogecoin, Roblox has a high volume. I don't think the volume came like it was supposed to. Okay, so here, this is in terms of volume. It turns out that AMC was not the biggest by volume on Friday, but you'll have Space, you'll have Palantir. You can click on them. So good volume risers, something to look at. And then you'll see that there's a ton of volume. What you want to see tick by tick. So that is this volume rocker right here. Do you see open, high, low, close, and then you have vol. Vol is the volume. You want to make sure that this volume, every tick per the minute chart would have about 20,000, if not 40,000. 40,000 is better on the low end. So you can see that this can fluctuate between like 1 or 2 million shares to about 100,000 shares or so. But generally what you're looking for is above 20,000 and hopefully above 40,000 per tick, even on the low ends. So you see the lowest end here, potentially not a lot of people would be trading it right before this. It's about 200,000. So you need to check it for your particular stock, but make sure that this is above 20,000 and hopefully above 40,000. It can go up to whatever it wants to, but on the low end of the day, whenever the volumes die down, your minimum volume must be somewhere between 20 to 40,000 shares. And we talked about the exchange, of what the exchange we want it to be on. So the next thing I want to do is talk about timings. So let's talk about timings. You can see with AMC this huge fall until 11, and you can see it day by day. So let's take it a day back. You can see a huge fall in the morning. So I would not trade these mornings because the metrics are still not good. You'll see a huge rise over here in the morning of the Wednesday, but the volume right at the beginning of day is where everyone blows their load and it gets to a point, but the rest of the day dictates the trend. So my best suggestion is do not trade the first hour the market is open. Ideally, it would probably be about 40 minutes within the day, but you want to wait for a full cycle of MACD before you can even consider the stock. So my guess would be make sure to trade 1 hour within the trading day. So your effective time to start is 10:30 to 4. 10:30 to 3:30, and I wouldn't even wait for the last 30 minutes before you sell out. Make sure you're cash by end of day, and that's what I'm going to say about that. The other thing to do about timing is make sure you trade only Mondays. So I'm going to change this to the 5-day chart or the 1-month chart. You're going to see on every Friday, so Friday be the 25th. So here's the 25th. You can see it go down. Here is like the 18th. So you can see the 18th is on downtrend. You can see, let me see, 18th, 19th, 18th, and then 11th. So 11th might be an uptick, but that's a very rarity. Fridays are generally bad days in the market, and the reason being is people are taking profits. So, other than strange occurrences, I would not trade a Friday. It's highly risky, especially for options. Do not trade, even if you're trading for the next week in options. What you want to make sure to do is that you don't place an option before the weekend, because after the weekend goes, you have a pre-market cycle, a post-market cycle, and that could take it up or down. But if it takes it away from your position, what happens is implied volatility. Your theta, and we'll talk about that a lot later, but goes down dramatically, so that you lose a chunk of value. Imagine you take your car off the parking lot of a dealership. The moment it goes off that lot, you drop a chunk of value. That's what happens on the weekend if it doesn't go in your direction. If it goes above your direction and you somehow made a lucky break, then all the plus to you. But don't even take the gamble. If gambling is wrong and you believe that gambling is wrong, do not take the post-market, pre-market gamble. The next thing that I wanted to talk about is to keep track of your day trades. I want to make sure that you are checking your account, you are checking your day trades left, and see how many day trades you have. This is not an account that I trade on usually, so it's only got 58 cents in value. But you have to make sure you have 3 day trades. If you don't have any trades left, any day trades left, then you have to skip the week out. Do not take a trade without a proper exit point, because then you are going to be trapped in an past market and pre-market cycle, which could, you know, be in your favor, but it could also not. And generally with the stock, if you hold shares, you're not really risking a lot by moving day to day. But the problem is it's still a gamble. It's still anyone's guess where the pre-market and post-market can take it. And I'll explain why that is, because each day, like during the trading day, there's a ton of volume. But then towards the end of day, I can't really see it here. It doesn't show it shows a time right here, but we're looking for time after 16. All right, you can see the volume right here go up to 20 million. Okay, I want to see a 5-day chart maybe. Okay, so assume that we got to the 16. It jumps. It jumps to 9:30 the next morning. So this is not showing the pre-post market, but generally if you were using this like the Webull trading app, you could see the pre and post market. You can see tick by tick the volume on the pre and post market is like maybe a few hundred to a few thousand at most, versus 100,000 to a million during the trading day. The problem with that is people can collude, they can upsell the value. There's no shorting that's going on in the pre and post market, so so values can go wildly out of whack. And the only thing is, does the next trading day support that value? If it cannot support that value and it comes way back down, then it really hasn't helped that much. So you don't trade pre-market, don't trade post-market unless you heard good news. Like here in the news section, there was something amazing that happened over the weekend, and Monday's a new trading day. Trading starts at 4 a.m. in the morning. So make sure that you're up, open early. You get onto the broker, you put in putting orders in extended hours, not in regular hours. You have to put in an order for extended hours, and you have to place a limit order well above where it was trading at to make sure you get your fill. because you can't do a market order. There's no way you can catch that rise unless you choose a value that someone's willing to sell it to you at from the last trading price and make sure that you've got in. And once you got your shares, then you can wait, and I would suggest selling pre-market shares still pre-market. So before 9:30 hits, right around the 9:10, 9 o'clock range, you sell out too. So you've kept pre-market shares pre-market, kept post-market shares post-market, and you keep on trades done within the trading day within the trading day. But it will still count as a day trade. So that's what you're risking. You're risking your 4 a.m. till 8 a.m. or 9 a.m. That being one of your day trades. So make sure of that. The last thing I want to talk to you about is entry and exit. We already stated that our entry for most stocks that we pick, let's pick IDEX. No, IDEX has a terrible barcoding pattern. You can see here, if it just chunks up and chunks down without continuous motion, you do not want to trade it. It doesn't follow indicators as well as it likes to. You'd like it to. But let's say Space was doing really well on Friday, but let's try NEO. More or less a continuous downtrend after the morning high. So it picked up and then it fell. But say we got it here. It hit the Bollinger Band on the upside, and then we could see it holding up. We have the exit strategy. You can have two exit strategies. You can have two successful exit strategies. One being that your indicator for your, let's get MACD, and let's get RSI. So the number one thing over here is that, okay, I can see selling pressure stagnate over here on MACD. It's not going higher, it's actually going lower. This is where I want to sell. I bought here, I sold here. Not too much of a profit, or, when we see it going down some more, even if it's over here, we can sell. So you need to sell on stagnation, or we can have that it goes underneath and tries to pick back up. We sell here. So this is a more conservative trading strategy. This is a more high frequency, or liberal approach, I would say. Not really a liberal approach, but more progressive, I would say. So if you want the progressive method, you sell out at stagnation. If you want the only problem with this is if it would go higher than that, you are missing out on gains. You just capped out. But you did make profit, and you did hold it within the same cycle. You didn't wait for a sell cycle to then decide, okay, I want to sell out now. And make sure that you know the cycles as well. So you have an entry. You can have two exits. You can have three exits as well. Say this goes up by 10%, 5%, 10%. You put a bar. So I can exit either if buying pressure stagnates, or if I'm up 5%. If you're up 5%, you get out, and that's a perfectly valid exit strategy. But you have multiple exits set up, and you have to follow through with them, not get emotional. So emotions, there is something called opportunity cost. Say you are in NEO and you have all your money stuck in NEO, and then you go and you see something like you can see something like Space, and then you see it pick up. Don't get FOMO and sell out your position over there and jump into your position over here, because we were tracking that trade. We don't know over here what the trade would be. there is absolutely opportunity cost. This is why I tell you to really consider your position before getting into something. But if you're in on something and you miss out on another riser, do not take your money out of whatever you just put it in and move it. And that is the one way that you can continually make losses, because there's transaction amounts, even though you cannot see it. When you sell out and then you buy into something else, you might be doing a market order, and that market order might buy you into a position at a price you were not expecting to pay. You didn't do as much meticulous DD on it. You just hear that it's running. So the fear of missing out, just jumping in from stock to stock, is a good way to just lose consistent value on your money. So keep those emotions aside. Play one stock at a time. If you miss a stock, you missed a stock. Don't try to then catch it. Like, there were a few times we were on that stream where there was one that was rising, but I told you, like, the rise has already happened. We're not getting in on a ground floor, so I'm going to be picky. I'm not going to join in. And that's the way you got to play it as well. So I hope this lesson was just kind of a break from all our informative lessons, just to talk about how you can, if you can list these out, list these statements out. Basically, how to add the stocks to your watch list. One, make sure they have high volume. They're mid to upper cap stocks with 1 billion in market cap, and their exchanges are OTC or NYSE, like NASDAQ or NYSE, not OTC. And then two, timing. Make sure you're 10:30 in, not 9:30 of the trading day. Make sure you're about 10:30 in, and it's a Monday to a Thursday, never a Friday. And keep track of your day trades. See, how many day trades do I have today? That's all you can play with, unfortunately, at this point in time. Unless you have $25,000 or more and you're playing with the excess, I would suggest, if you do have PDT, keep your $25,000 there just as a buffer zone. Always play with the money on top of that. Now, setting up exit and entries, you can have 3 or 4 exit strategies, a few entry strategies. Make sure that you play it both, and then also, doesn't matter if you lose, make sure you sell out. You follow through with your exit strategies. Don't let your emotions kind of follow with you, and that is the basis of today's lesson. If you can like, comment, and subscribe towards the series, it would really help, and kind of share this with your friends. Hopefully everyone will be a lot more informed in investing. All right, thank you, and have a nice rest of your day.